For some people, real estate is a taboo and a very complicated way to invest their dollars. It's not completely passive. You still need to be worried about tenants, property taxes, insurance, and vacancies, as well as maintenance. So, what's another option people have to invest their money passively? In this video, I will talk about index funds, which means you can buy a little piece of many pies instead of buying a big chunk of one single pie. Let me show you the best ones for 2023, so stay tuned. Hi there, welcome to your channel, The Foreigner in America, where I teach locals and foreigners everything related to money and personal finances, including investing in the markets, real estate, your side hustles, and everything in between. So if you're someone like myself who wants to achieve greater wealth in life, you don't settle for pennies but for Benjamins and loves money, please subscribe to this great channel and hit that bell so you don't miss any one of my 2 weekly videos. Also check out Instagram, TikTok, and my blog at The Foreigner in America. And I have a book who's a very solid read for everyone wanting to be above average in their lives. And I will leave a link below for you to check out. So without further ado, let's begin. When you have all your money in a checking account, it's very safe since it's FDIC insured. But after many years, you have nothing. Inflation eats the money and you become poorer every day. I like to invest in real estate since I can make money 4 ways: cash flow, appreciation, leverage, and tax savings. The only thing about real estate is that it's not completely passive. You cannot automate a withdrawal from your checking account into a brokerage account every month and just forget about it. How can you do that? Well, you can do that with index funds. When you invest money in a stock, you're buying a piece of a company. Depending on the company's performance, the value of the stock goes up or down, making you money or wasting your money. And you have no control over it. You rely 100% on the CEO and the management team. If something like FTX happens, you lose 100% of your money. So people were reluctant to invest in a single company because they could lose it all. This is where the index fund was created by Vanguard. John Bogle, founder of Vanguard, came with the Vanguard first index investment trust in August of 1976. And from there, it tracked the index and minimized fees. So people loved it. What an index fund does is invest your money into many companies. The bigger the company is, the more money they invest on it. Apple gets a lot more money than a smaller company of the S&P 500. If one company fails, your money is not all lost, but only the little portion you invested in that particular business inside the index. So nowadays, Vanguard is not the only one with index funds. They're still everywhere. I will still show you the 5 of the best Vanguard index funds for you to consider this 2023. Remember one thing, the market right now is a bear market, which means that the value of the index fund will continue to decline. Don't panic if you put $1,000 in an index fund and then it's $900 the next 30 days. As the value of the fund declines, you're able to buy more and more shares, which will make you come up richer at the end. So when you automate a certain amount of money every month to buy an index fund, the cheaper the fund is, the more shares you will buy. The total amount of money you have is the number of shares times the price of the share. These are the best index funds you can place your money at for 2023. So take notes. Number 1, VTSAX. This index fund contains the entire stock market. It's a great way to stay diversified since it has a piece of small, medium, and large cap stocks. A total of more than 4,000 of them. Imagine how painful it will be for you to actually own 4,000 different stocks and track them, and then level them on a percentage of your income and see which one is making money and which one is losing money. That will be a disaster, way harder than real estate. Just buy VTSAX funds and you will automatically track one single thing. Number 2, BFIAX. If you don't want to be that diversified, meaning that you want only to invest in one of the indexes, there's like the S&P 500, you have the perfect index fund for it called BFIAX. This fund is not made from 4,000 companies, but only 500. The largest and most important 500 companies in the US stock market. Companies like Google, Apple, Microsoft, Amazon, and others comprise this index. Number 3, VTIAX. If you have foreigner blood in you, like me, you also want to take into account other markets besides the US. So markets like Europe, Middle East, entire America region, etc. Multinational companies like Nestle, for example, are in this index. So what you can do is combine some money on the US total market and another part on the international market, and then you have a piece of all pies. Number 4, VIGAX. This index fund is like a VT-SAX on steroids. Instead of investing on all the companies being small, medium, and large, this fund will only invest in growth potential companies like Apple, Home Depot, etc. So they take into account P&Ls and distributions. Good option to be less diversified but more aggressive. And number 5, which is my favorite one, VDIGX. Some people will say you should invest in other funds like the total world stock market, which I think this fund is much more important than that. You like to invest in companies like Coca-Cola that distribute dividends to investors. You can make money with the stock going up in value, and you make money by receiving dividends, which are taxed less than regular income. So this fund tracks all companies that distribute dividends in the US stock market. Now, stay with me for a little bit before you change the video to watch Mr. Beast giving away $1 million inside of Walmart for fun. It's important that you hold a cash position these days, especially in a recession. Why? Because in case of an emergency or a loss of income, sickness, or any unpreventable situation, you can grab cash and solve. Cash on hand solves problems. The lack of cash creates problems. Write that down. But how much cash? This is what differentiates the poor from the rich. Poor people have 100% of their cash on hand. They're very risk adverse. They don't want to take any risks, so they don't invest on anything because they don't want to lose a single dollar. The problem is that they're losing like 10% a year due to inflation and some bank commissions. Now, putting 100% of your cash into an investment is not a good idea since you need cash on hand. The good thing about index funds is that they're very liquid. So you can sell them and get the cash in a couple of days. It's not like real estate where you need to sell the property or get a home equity loan where the lender wants to destroy your finances and charge you like $30,000 over the loan just to give it to you. Terrible idea. Have most of your money into index funds or real estate, a mix, right? Have a percentage of your money in cash in a checking account for emergency situations. You can put it in some sort of high yield savings account to lose less. So that way, if something happened, you could access that cash and not touch your investment, especially in a bear market. If you're a real estate investor like me, then follow me so you get more good tips on how to make money there as well. But remember, take control of your life and take control of your money. Thanks a lot for watching this video. If you enjoyed it and found useful information, give me a like, subscribe, and hit that bell so you don't miss any one of my 2 weekly videos as soon as they come out. So have a great day. Don't lose any money, and I'll see you next time.